Hey everybody, welcome back to the weekly market analysis, this time for the week ending December 16th, 2022. This is going to be the last weekly update of 2022. I'm going to be taking a break for the next few weeks, but I just want to take a moment to encourage you to smash the like button. Go ahead and subscribe to this channel if you haven't yet. Share these videos with people if you think that they're helpful. You can also follow me on Twitter at Mr. J. Thomason. You can get on the list to subscribe to my newsletter, which is going to be relaunching on Substack. You can find that in my Twitter bio. We're starting in 2022 with the Substack newsletter. Obviously, this week we're just going to dive right in. We had some big news events this week that we'll start off with. First of all, we have the CPI report that came out on Tuesday, and CPI ended up being misses, meaning when we say the word misses, we're saying that CPI came in below expectation. For some reason, they call that a miss, even though it's supposed to be a good thing. So CPI headline month over month was coming in at 0.1%, and then core CPI at 0.2%. And both of those were estimated to be coming in at 0.3 month over month. Obviously below, both of them were below on the year over year basis as well. And that led to a really big boom in the market. But then it didn't hold. So you can see here the daily candle. In fact, what we'll do is we'll go to a 1 hour chart and we'll come back to Tuesday. You can see when the CPI was released, just a really giant candle on the hourly that started to come off. And then interestingly, price did not stay up. If I go back to the daily chart, you see that, sorry, it's all messed up here. You see that we ended up retracing quite a bit of that gain. And I said on Twitter, it kind of reminded me of, excuse me, of back in, I want to say it was in July, where the markets on the CPI report for June, the markets had been up on the day, and then price came off pretty substantially, and then ended up retracing quite a bit of that drop. Obviously, then the next day we dropped, and then pretty far, and then came back up again. So to me, that price action seemed familiar, but to the other direction. And so I suspected that, and I saw somebody on Twitter, I don't remember who it was, but somebody shared the post, posting that this was your Christmas gift to sell. And it's turned out that has been a pretty good call. The markets if we go from the peak of that move, the markets are down over 7.5% since that point. I'm trying to get rid of these drawings so that it's a little bit more clear. But now it looks like the markets are about to roll over, and the reason why is because the day after we had the Fed closing up their December meeting, FOMC meeting, and they raised interest rates by 50 basis points, which had already been kind of baked into the cake here. But then Powell got really hawkish. Now, oops, I'll show you that chart in just a second. Let me go back to the hourly chart again, and we'll zoom in more on this section. So we had actually kind of an initial, let me go to a smaller time frame. Let's do a 5-minute time frame. This will be a little bit better. Okay, so let me get over here. So let's just take a look at CPI really quick. So what was funny was the CPI report hadn't even come out yet, and the market started bidding. So that was kind of interesting to me as well when I looked at the price action. But if you look on the initial release of the FOMC statement, price actually came off. The statement wasn't really a whole lot different, and I'll explain why the sell-off happened in the first place. And within 30 minutes, price had come down. If we start from the beginning to the close of this 5-minute candle, price had come off 2.5%. or not 2.5%, just over 2%. And then Powell started speaking, and price began retracing. But then price ended up consolidating sideways, and then it was kind of, I mean, it was still down. It stayed down. I think the markets were getting really excited when Powell was continued to talk about slowing and watching data and stuff like that. But he kept saying substantially more evidence, which is different from, a lot of people have been making a big deal out of this, different from when he's been saying clear and convincing evidence. And then if you just follow the 5-minute time frame, kind of stayed in this kind of sideways range for a while. And then on Thursday, we started getting into Bank of England and ECB news, and price just started coming off since then, and it hasn't really let up, just been basically down ever since. So why was, sorry, I've got my drawings up here again. Why was the FOMC meeting, why did it turn out to be hawkish? It really comes down to the dot plot. So right here, what I have is the updated dot plot, which was released on Wednesday. The dot plot shows the majority of the dots between 5.0 and 5.25, with a couple of dots that are between 5.25 and 5.5, and then some dots that were between 5.5 and 5.75, and that's actually a really big deal. And the reason why that's a big deal is because if you go to the previous dot plot, which I have up now from the September SEP, you actually have no dots above the 5.0 mark, right? So we're again looking right here, if you follow my mouse, for the end of 2023, because the Fed has been saying, Powell has been saying for a few months, higher for longer, higher for longer, higher for longer. And so, back then we still had one dot sitting here below 4.0, which was pretty interesting back in September. But then Powell has been saying on a pretty consistent basis since the September meeting that their projections for the terminal rate were actually going to be higher than in the September SEP, and that's what this turned into. And in this case, there's pretty good consensus that the range is going to be somewhere between 4.75 and 5.75, somewhere in that range. And so you can see here that all of the dots for 2022 are here at between 4.25 and 4.5, and because that's where rates are ending here. Excuse me. And so rates are ending there, and so they actually are seeing a forecast for a couple more rate hikes, which is a pretty big deal. So that's actually why the markets sold off a few on the initial news. Excuse me. Got excited when Powell initially started talking, and then sold off again as the markets continued to digest this dot plot news. And this is something that, even though I got CPI wrong, I was definitely surprised that CPI was lower than expected, just because, a lot of people like Darius Dale have been doing a lot of research on the time series that in which inflation comes down, and it's basically been a historic level of disinflation that has been occurring in this CPI report and then in the previous CPI report in consecutive months. So I talked about being wrong about the CPI, but and the markets obviously were bidding at the time. So at 7:50 a.m. on CPI day, the markets had been booming. I think the NASDAQ was over 400 points up. But I said, but I made a comment, the most important thing that they talk about is not the pause, which we all knew was imminent, but for how long they plan to keep rates high. The dot plot matters again. And this is just the most recent tweet that I had made, but I had been saying the dot plot was going to be something that mattered, and obviously it does matter. And I don't have the curve up here, but the Eurodollar futures were actually pricing in that the Fed was going to pause somewhere in the 4.5 to 4.75 range and then cut at least once or twice before the end of 2023. So that would be so if you see on my screen these dots, this cluster of dots, which is actually in 2024, the market was pricing that these dots were going to be in that spot, but over here in 2023. That's what the Eurodollar futures market had been pricing in. So This has really jogged the markets kind of out of their complacency and kind of shocked them out of their expectations for where rates are going to be at the end of next year. Now, I think to some degree the markets still don't believe it. And I think that has a lot to do with like yields, which of course yields are up today, um, but long bond yields have actually been still coming off to a degree. Like they're not bid quite as much as like the dollar is pretty bid the last 2 days. If you go over the last 2 days since the FOMC meeting, yields are near break even since Wednesday. So that's, I mean, I think that that's because the bond market is starting to price in that slow in growth and that recession. And obviously we've got the, the yield curve inversions showing that we're going to have a recession, the 10-year 3-month. I don't have the chart up, but I made a big deal with somebody on Twitter recently about how when the yield curve inverts, it signals that the recession is coming, but then there is a point where investors begin to believe that bonds are going to be the safe bet. And I think that time is, if it's not already here, it's just about here. And I think that that's why you're seeing, excuse me, the 10-year, the yield still coming off. And then also, I think, where is it? TLT has still been kind of coming up. Obviously, today was not a good day for the 20-year, but or 20-year plus bonds, but it had been doing just fine in spite of that. You actually saw TLT came up or was up still on or came up on Wednesday still, and then was also up on Thursday. So I wanted to mention that as well. But in any case, I bring all of that up because now the markets have kind of like there's no more like I said where did I say it? I said kind of back in November, I think on November 10th, when the October CPI report came out. I said there's no more macro catalysts until December that can change the trajectory of the markets. And in this case, I'm going to say the same thing to the downside. And there are other dynamics at play here. And before I go to the other indices, I just want to make a comment here. If you just look at, this is all the futures performance of the major indices last week. I tend to post this on my newsletter, but I'm not going to be posting a newsletter until January, so I'm going to show you this here. But you can see on the CPI report, you see the big gyrations in markets on that day. And then on FOMC day, you see more action that's taking place as well. So just some clear things going on. And then Thursday into Friday, you had some action on crude oil and on Bitcoin. And so, yeah, that's been really interesting. So I wanted to make a point about dynamics going into the end of the year. So we have a net liquidity chart right here. And you can see that SPY, excuse me, SPX is coming off more in line with net liquidity. Now, this is not a totally updated chart. It's got to get updated a little bit more still. I think we're missing 1 or 2 days or something like that. I have to check on that. But net liquidity has been coming off, and the S&P has been really, really rich in comparison. Of course, Bitcoin has been leading net liquidity. Again, that chart has been around ever since Darius Dale brought it up with 42 macro, and Morgan Stanley lifted it. I think we've all been lifting it, honestly, but credit to where credit is due. So price is coming. SPX is coming off more in line with net liquidity, and the net liquidity dynamics seem to me that they will be getting worse. Just again, we've still got guidance for the TGA that the TGA balance has to be to a certain point, and that's going to remove net liquidity. We've got the Fed still doing QT, and then the big one is the reverse repo facility. Just given the hawkishness of the Fed, it's hard to imagine. The reverse repo facility creating favorable net liquidity dynamics anytime soon for markets. So this appears to be ready to come off even further. The blue line, it'll probably be coming down. even into early or into January and potentially even February of 2023. So the net liquidity dynamics are not favorable towards the markets. And then you have I don't have it. I don't have a page up. I'm sorry, but we have on Friday. Well, when we get into the end of December and beginning of January, we'll have the PCE report, which I suspect is going to show again maybe not an acceleration on a 3-month annualized basis, but more of a holding on 3-month annualized basis of core PCE, which is what the Fed really cares about. And then we're going to have on Friday, January 6th, we'll have non-farm payrolls. And then we'll have the next CPI report on Tuesday, January 10th for December. And so the macro catalysts, let me see, I'm going to stick a vertical line here. I'll do that. The macro catalysts, the big ones, we'll just ignore core PCE. I'm not exactly sure if that's going to be released in December or in January, but we'll stick a line there. And we'll stick a line right there. So 2 macro catalysts pretty quickly after the other that will have an impact, but there is a lot of space between now and then for price to come and fall down now that I'm talking about it into this box. Excuse me. And my running thesis for a while has been, I think I was talking about this back in late November, and early December, but my thesis has been that the net liquidity dynamics and various other issues were going to lead to markets falling down again and then bottoming. I talked about, I think Bitcoin is going to bottom in the next 30 to 60 days. I think I said that somewhere in this vicinity right here. And so, excuse me, so I think that there's a good chance that markets are going to find a pretty durable bottom sometime between the end of this month and maybe into the middle or end of January. I don't really want to put a huge timetable on it, but I am expecting price to hit this box, somewhere in this box. It's a pretty large range, but I think that that's fair. And what I have also been tracking, which a lot of people haven't been tracking, and I'm going to just, again, delete the drawings for a second, because a lot of people have been drawing like wedges or flags or things like that. And the problem is that, I mean, I haven't seen anybody really talking about broadening wedges, which when you have a run-up, maybe you wouldn't call this a run-up, but when you have price moving up and then it goes into a broadening wedge, that tends to mean that it's going to reverse to the downside. And so we broke the broadening wedge. This is just a rough sketch, so I'm not. It could bounce back up, but I made this immaculate call back. I think it was back on either the 6th or the 7th of December that we were going to get a bounce into Tuesday, and then it was going to come off, and then we were going to come down and break down out of the wedge, the broadening wedge, and we have done that in a week. Crazy. So I think that price is going to get into this box. Nothing happens in a straight line usually, so this could be quick, or it could kind of drag along to get down here. If things turn out very unfavorably, so the crux here is going to be, will payrolls and CPI surprise to the upside? I posted a tweet earlier today saying, what do you think is going to happen if CPI and payrolls actually do surprise to the upside? So if CPI, maybe the immaculate disinflation that we've been seeing from the October and November CPI reports, maybe in December the December report is going to show inflation accelerating again. And if it does, and then if payrolls still come up hot or hotter than forecast, then this box, all bets are off. This box actually could be a lot lower. But you should be prepared for price to get down into this, at least into this box, on the over the next few weeks. That's kind of my base case. Let me see. Today's price action. Today we had, I think, like over a $3 trillion OPEX, or maybe it was a $4 trillion OPEX. It was like the second highest ever on record, and obviously price is coming off now because there's a lot of options that are being unwound or that were in the process of being rolled things like that. I do want to pull up this chart because this chart shows you like these lower two blue dotted lines are showing you actually where the put wall was, at least on this the upcoming options expiry, which was again today. So it doesn't surprise me that price came down pretty close to there and then had a bid. So that kind of explains today's price action. But in any case, price is coming off bearish. We're making lower lows. We broke down from horizontal resistance. Things just don't look very good. And a lot of people are scratching their heads, not understanding why all of this is happening the way it's happening. A lot of people have been talking about, let me go to the gold chart. I think the thing with gold is the markets believe that, are starting to really believe now that growth is really going to come off. So for a lot of this decline, the biggest issue was that real rates were increasing, the dollar was increasing, and growth in the U.S. economy was still very robust. Now we've got a couple of those dynamics changing. The dollar has been coming off, real yields have been coming off, and then growth is actually, like, I think the markets are buying the fact that growth is going to be coming off, and they're front running that. So all of the things that were bearish for gold basically since March after the spike from the Russia-Ukraine invasion, all of those excuse me, dynamics that served to push gold down have started to change, have started to flip the other direction. And so I think that's why you're seeing gold bid. Now, as far as markets go, this is another thing that I talked about. I posted it on Twitter recently. I'm going to highlight my 50-day and 100-day, I'm sorry, my 50-day and 200-day moving averages. And I want to show you, we had a golden cross on the CPI day. And I made a big, I made a post. It was a long time. Well, I don't remember if I showed this in the video. Forgive me if I'm showing you all this again. But I definitely made a Twitter post about it. If you go all the way back to, it's not even going to show up. I feel like I did this last week, but so let me just go back to now. I made a post, and I think I showed it in my video, that if you look back at the dot-com bubble from 2000 to 2002, 2003-ish, and you look, the Dow actually had multiple, I think it was three golden crosses where the 50-day cross is above the 200-day before, while still making lower lows. So it crossed and then made a lower low, and then crossed and the price made a lower low. And it did that 3 times, and it wasn't until the 4th time that the golden cross actually was like showed that the bottom was in. So I pointed out on my post, and maybe in my video, but I definitely pointed out in my post that the crossing of the 50-day to the 200-day was actually a top signal. And so I made a big deal about it. And sure enough, it looks like it's about to be the topping signal, or that it was the topping signal for this bounce. And granted, we closed lower than back November 30th, but the spike was definitely the high. So yeah, and now we've made a kind of a lower near-term swing low, so I'm going to be watching that. We need to see if price is going to catch the 200 or the 50-day moving average. But obviously, like, I think that may prove to have been the top of the bounce. If you go to the NASDAQ, similar kind of broadening wedge situation. Of course, the line is really crappy, so I think we did close below. And the zone, the drop zone here is a lot wider. I could see a scenario where we get, again, depending on the dynamics relating to net liquidity and then what happens with CPI and payrolls in January, but I could totally see a situation where we go under 10,000 on the NASDAQ. And I think that would be a pretty big deal because if we get, because the top pre-COVID for the NASDAQ was 97.48. And I think we could bounce there. I think that if things shape up just right, or maybe just wrong, I guess if you could say, then we could see the NASDAQ get that low. And that seems so crazy considering that the NASDAQ on a wick basis got up to as high as 1676. So that would be almost a 50% drop. So if we actually show that, let me go find that here. If we go from the top to that horizontal level, approximately so, let me try to get down kind of close to it, then that would be almost a 42% decrease in the NASDAQ. So I'm not saying that's going to happen, but it would not surprise me at all. But I do think that it's likely that we see the bottom in the next. I'll just kind of keep my kind of day range in the 30 to 60 day range. Excuse me, 30 to 60 days from now would also include February. So I do want to make the caveat there that that depending on how the inflation, payrolls, and net liquidity dynamics play out, it could extend into February. I'm thinking more the near side of that. In fact, I might even venture to say that, if the January 10th report on the December CPI comes in and we have another consecutive surprise to the downside, then I think that will be the bottom, because then the FOMC meeting happens on Tuesday, January 31st, and Wednesday, February 1st, and that'll be, I think, that'll be the catalyst for maybe the Fed will hike one more time, and then that'll be it, and then they'll signal that that'll be it. So I think this is the window for, unless something bad happens, I think this is the window for taking a little bit of risk to the downside. And then let's take a look at the dollar. Excuse me, got a little bit of a cough here. The dollar is coming out of, or had broken out of, this wedge. I don't know if this wedge is legitimate, but it has been working. So I'm going to stick with it for now, and we'll just see what happens. We'll see going into, again, if the liquidity dynamics and all that stuff doesn't play out in a positive way for risk assets, then you could see the dollar come up and probably test close to the 108 level. And then if we get a sustained bounce, we could go up maybe as high as 111 or maybe up near 112. And and the reason why here is, and I don't have the chart in front of me, but or I don't have the data in front of me, but the positioning in the euro is crazy long euro. And so if for some reason, because of all of these things that I've been talking about in this video, if those things play out unfavorably, where people begin to unwind those long euro positions, you could see a ferocious DXY rally. So not just that data about the long trades, but also the ECB came out super hawkish. And what I've realized about this, because a lot of people are saying, well, why is the euro? Let me actually go to Euro USD here. A lot of people have been saying, well, how come, based on what the Fed did and then the ECB coming in super hawkish, why did the euro sell off versus the US dollar? And I suspect the answer is because hawkish ECB equals bad growth for Europe, and if they're going to be, and if they're hiking into economic downturn rather than being more dovish, then that's actually bad for the euro. There's been some discussion and data analysis done by a couple of different people, but suffice to say that the summary is that when growth is good in Europe, or when the dynamics of liquidity and rates and things like that are good for the Eurozone, then that tends to be positive for the euro. And so those things are changing. And so if this thing had such a huge it's been a big long downtrend for some time, but just a big move that has happened in such a short amount of time. The euro moved over 11% in about 3 months. So if this was just a relief bounce, I'm not saying that the euro is going to make new lows versus the US dollar, but if this was like a relief bounce and we have to do a retrace of some sort, man, this could get really, really crazy really fast. So I think that you have to be aware, even if it's not likely. I'm not saying it's likely. Like if you look at trend line, what was resistance, we broke above it, and it's now support. So you can actually see we bumped up against it and then got above it and closed above it, and then I've come above it, and we could come in for a retest here. So I think from a technical standpoint, I'm inclined to think that the euro is just going to come and retest this trend line, and but anything could happen. I mean, like macro and flows and stuff don't care about your trend lines, so you just have to be really careful and consider multiple different outcomes and position yourself accordingly. So I thought that was something important to notice. Yields, I kind of already talked about yields. I don't really think that this trend line or that this wedge pattern is legitimate, so I'm going to delete that trend line, and I'll delete this trend line too. So just be watching yields. We're kind of bouncing along the old summer highs, which is interesting when you consider, let's see here. We back in February and into March of this year, after we had spiked back up above 2%, we came off and tested the highs from mid 2021. So kind of a similar thing playing out here. We'll see what happens. I'm not saying that yields will make new highs, but you just have to be really careful about that, especially because again on the 10-year, the dynamic here is like, I think that, like if we go find, let me see here, see if I can find my 2-year. That's the 3-month. So the 2-year right now is trading at over 4%, and then the 3-month is trading at like 4.3%. Could both of those go up to like 4.5 or close to 5%, or potentially even over 5%? Yes. But what I'm going to be watching is if those yields are moving up, and if the 10-year yield is moving down, and the other long yields are moving down, then that's definitely going to be the bond market signaling the recession is coming soon, and that potentially a big market correction or maybe crash is going to be coming soon, because that would be like the return to the bond safety trade. And that's something I think Michael Guyette has been talking about that on Twitter and in his videos. So just something you should be aware of, left tail risk here. So crude oil had a bounce, but it looks like it's going to sell off. Doesn't really look great. Bitcoin coming off, breaking down below both of the possible trend lines that I was looking at. So it looks like, oh yeah, that is the one I want to get rid of. So it just looks like this is getting ready to roll over and come lower. And just for everyone watching, my MRT is showing the orange line down at, let's see, 11,794, and that's a big risk, because in every bear market, the Bitcoin price has touched that line and crossed it at least. So it hasn't done it yet. It was really close back in June, but it did not cross below. So watch out, hedge, be careful. And that's where I'm going to leave you guys today. I know it was long, actually longer than normal. Sorry about that. If you made it through, hit the like button, leave a comment if you thought this was good analysis. Share this with somebody. I think it's really important that you're aware of what's going on, why things are happening, and what the risk is going forward. So thank you for watching, and I will see you guys in 2023.